your guides to a really great financial future. Tom and Don are talking real money.
Good morning, good evening, good afternoon. This is the latest economic news. I'm Don McDonald. The S&P 500 on Monday plunged to levels not seen since late June. And then the next day recovered most of those losses. What does this mean for investors? Well, Talking Real Money's Tom Cock joins us from Bellevue, Washington. Tom?
Thank you, Don. First, let's check the numbers, then we can talk about the significance of all of this, right? Okay, first of all, on Mondays, you just reported the Dow Jones Industrial Average, which we do not pay attention to.
Oh, wait, you're not allowed to quote the Dow Jones Industrial
Okay.
Average. I'm sorry.
Moving on from the Dow Jones Industrial Average to the Standard & Poor's 500.
Thank you.
Okay.
You almost destroyed our system. We are Dow free.
1.6%. 1.6% on Monday, which
1.6.
led to
Yes.
panic, which led to media interviews, which led to none. I checked with all the advisors yesterday. Not one client called. Not one, because our clients are well trained. But the next day, stand by, because we're headed to new heights we have not seen since late June. The S&P 500 down 1.6% on Monday. Guess what? It was up 1.5% on Tuesday. I think that's a 1/10.
Didn't I pretty much, as the anchor, say that without numbers?
But it makes it more authoritative when you throw it to the financial desk and covers it.
So what does this mean for investors?
Well,
you haven't told us that yet.
I've got more.
No, not more numbers, Paul Merriman.
Paul Merriman, not available today, but stepping in ably
with numbers.
At the financial desk.
You have any charts you can show us?
Oh, yeah, I got charts.
I got charts.
They don't mean anything, but
I'll show you some charts. Yeah, what do you got there,
100% globally diversified stock portfolio year to date through the close of business yesterday, up 16.5%. Doesn't sound like a time to panic yet. The Standard & Poor's 500, far less stocks, up 15.9% year to date. And Don, for those of you who really want to go back, how about 50 years of data? Let's go to the financial desk for that. 50 years.
Let's go.
100% in stocks.
Let's jump in the time machine. And
all
head back.
the way back to 1970, which, correct me if I'm wrong, the Milwaukee Bucks just did that for the first time since 1971. But a 100% stock portfolio up 12 point. I know that was a basketball reference. Congratulations to the Bucks, who won the NBA title for the first time since a guy named
apparently
Lou
1971.
Alcindor was playing for them, now better known as Kareem Abdul-Jabbar. 100% stock portfolio up 12.1%. Standard & Poor's 500 in that same time up 10.1%. Don?
Okay. Now, if you're totally sick of numbers, as I am, what is all this? This is the point of all this is, what does all this mean? We've always got the media. You've been interviewed on Como Radio. The people want to know what's happening day to day, but does it matter?
It does matter. Let me tell you why it matters. It keeps me employed, for one thing. My phone works. Call me. I'm glad to do an interview and explain.
Okay.
Well, that day there were more sellers than buyers. The next day there were more buyers than sellers.
How do I explain to you that it's not all about you without hurting your feelings?
I think you just go right out and say it.
It's not all about you.
Okay, I'm over it.
And I return to my original question as financial news anchor.
Yes.
What does it mean for investors?
What it means is, number one, expect volatility. Expect ups and downs, because over the long haul, you've been paid for taking the risk. You've been paid for accepting the volatility. Number two, and this is painful because, as Don just pointed out, it's not all about me. You got to ignore the so-called experts. And by the way, the experts, the part that makes me nervous, because what does Jim Cramer say on the big down day? Well, you should be nervous about what might be around the corner. He has no idea what's right around the corner. That every time something happens and the experts tell you what's next, that's a time to change the channel back to music. Sorry to say. And number three.
No. Stay on talk radio. Just don't go to the financial talk shows, please.
I'm sorry. Because we got beat by music here in Seattle in the
Yes,
last book, as
keep
painful as that is.
everyone in the Seattle area, please keep listening to Como 1000 AM, 97.7 FM
Look at
on
you.
Saturdays from noon to 2.
Well done. Number 3, if you were scared by the tumbling stocks falling 1.5% in one day,
Yeah.
here's an idea. Take the free risk quiz, build a portfolio that matches your need for return and your emotional ability to take risk, or hire someone that stands between you and your money, because we know people do bad things to it when markets go up and when they go down. Don, back to
And
you.
then, after you've done all that, leave it the heck alone. Go to the beach, go to the mountains, go read a book, go enjoy your life. Quit worrying about the stock market. Thank you.
Your life will be better.
Oh, Tom?
Yes.
Yes. I don't know why I look at the screen because you can't actually see me. I need to look into the camera. It's like getting used to something totally different. You always want to look people in the eye, except when you're recording videos. Then you want to look them right in the camera. So,
Yes.
Tom,
Yes.
we have for you today the world's longest question.
Can I take a break and come back?
Never seen a question this long. The guy must have writer's cramp.
All right, I'm taking notes so I can answer.
We take them in the order in which they come. This one comes to us from the great state of Alabama. That's in the South, in case you guys, from the Northwest have no clue. That's in the South.
Go ahead.
The subject is awful 401k account. Sounds like a children's book, doesn't it? The awful 401k.
You're really, really bad.
Tom and Don, and sometimes Paul. I've enjoyed your podcast. Yeah. I'm sorry, this is so long. I gotta. Okay, ready? Are you ready? Okay. I've enjoyed your podcast ever since I found it a couple of months ago. I appreciate the thoughts you offer as industry insiders and the way you obviously enjoy working together. That's all an act.
And by the way, we are not insiders in any way, shape, or form. But
well, we're in the industry. I think that's what he means.
All right.
Okay, we are in the industry.
Suggest somehow that we have knowledge that others do not.
Yeah, no. We just have we've been working in the financial services industry for a couple of days.
Seen a couple things. Not our first rodeo. Yeah.
Yeah, no, I would never be in a rodeo. And
you're Coloradan, you should be in a rodeo. Come on,
man. From what I've heard, you're the bull. So let's move it on to the next paragraph.
Leaving it at that.
Since the 2 or 3 of you have well over 100 years of combined experience in the industry, I thought I'd ask you for your thoughts on my wife's awful 401k plan offered by her employer. My wife's employer is a small private school in Alabama. A few years ago, they changed the 401k management firm from one awful insurance company to another, and the employees are still getting screwed. The employer provides a 1.5% match, which sounds okay. He actually put that in.
No, he had a yawn in there.
He did. He had a yawn in there.
Wow.
Yeah. So I acted out.
Well done.
However, when you add the standard mutual fund fees, you ready for this? When you add the standard mutual fund fees plus 0.65% for record keeping, plus 0.9% for administration and management,
that's too high.
The robbery fee portion at 1.55 is quite egregious. That's 1.55 plus the funds.
Yeah, which are?
I don't know yet. There's more to come. Should we take a brief break for a message from our sponsor while
Let's go back to the financial desk and we can report that the markets. No, okay, let's not. But okay,
all right, we're gonna. Here we keep going. For some of what follows, I'm referring to the company's PDF for their fund expenses. I could supply this if provided the means to do so. So, as an example, if she were to utilize the money market fund, it earned 0.57% for the year period ending in May. However, the high fees mean she'd actually pay negative interest for the privilege of investing in the money fund. If we just ignore inflation and the standard mutual fund fees and address only the 1.55% robbery fee, here are a few noteworthy observations regarding her account that's just over $100,000. The robbery fee is nearly $1,600 a year. The robbery fee for a quarter, 1/4, is nearly 3 times the employer match.
Pardon
All
me.
of my wife's 401k contribution for January, February, and most of March disappears into the annual robbery fee. I'm sorry, I'm laughing. This is kind of sad.
Yeah.
If my wife were to select more conservative funds, her account would simply become a cash machine for the insurance company, and the growth of the balance over time would be in doubt. For several years, I've attempted to politely cajole her employer into considering better alternatives in the way of 401k management companies, but it's fallen on deaf ears with words about high costs to small employers, and I get that. However, my understanding of the Secure Act allows for pooling of small employer funds to gain access to lower fees, but I'm not sure that's really much of a market presence at this time. I looked into Fidelity. There, we each have a Roth and an IRA that mostly represent former 401k accounts. But Fidelity is starting out with a pool available only to employers that have never before offered a 401k. All of this to ask 2 questions. 1,
Yes.
is there some resource you might suggest I contact that will offer them information on pooling options for small employers? Or if pooling is still on the horizon, what other options can they consider? 2.
Wow. Oh,
Wait,
can I
you want
ask?
to do one?
Well,
Let's do
number
one.
one, yeah, I just read in the Wall Street Journal today there is an opportunity for people to rent time at pools. Is that what he's asking? Because you can do that and go to individual homes. There's a service where you can rent them
Excuse me, but
for a period of time,
there
and
are
you can jump
times
in
for
them on the
levity.
hot days.
Excuse me, sir.
Yes, yes.
There are times for bad dad levity, and there are times for serious answers to serious questions.
Okay. I like the robbery thing. I'm still
Yeah, I do
laughing
too.
about that. That's good.
But is there a
Uh,
resource that he can provide?
I don't know. I'd have
I,
to. I'd
I
have to
can't
dig
think of
around that.
one.
I don't. I'm trying to think.
And what other
You know
options
where I would go.
do smaller employers have?
Well, you know where I would start?
No.
Probably find a small business organization of some kind. Start with them because they know
Mhm.
all of the resources. I don't know that it would be the SBA, but what's the other one where they coach? There's this coaching
Score.
service.
You talking about
Yeah,
Score?
Score. I might try somebody like that because they
Mhm.
deal with all of the nuts and bolts of having a 10-person firm and if you want to have a retirement plan, what your options are.
That's a good
Yes,
idea. And there's
they are
probably also an
top.
organization of small private schools. There probably
Yeah,
is some sort of a private school organization
and they may
that
have a
offers
pool.
401ks. But
This is a horrible plan. This is awful. And by the way, so here's my take on what to do if that's the question. Is that the question?
well, that's one of the 2 questions.
Okay, go on. I mean, so go to Score, which I think is a great alternative. Just like
It's
Score.
the senior core of retired executives. It's people in the business
Yeah,
community.
and they will
Um,
help you. This would be a starting place. There is no sort of federal clearinghouse I'm aware of where you could go find that out.
would you like the second question?
Yes, we're doing well so far.
Am I correct in understanding that the employer's plan administrators are personally liable for boxing employees into these egregious fees? I have never sued anybody, and that's not my plan. But all it takes is one dissatisfied employee that upon retirement, that upon retirement to open a case with. What, the Department of Labor to explore that avenue? Yeah, the Department of Labor is a good place to explore that avenue. Absolutely. I recently ran into a long ago employer, sole proprietor, who was lamenting that the federal government had investigated him and determined his management of employee 401k offerings was so awful that they liquidated his account and split the money among his employees.
Wow. So yes, I believe that both the plan sponsor, which in this case would be the employer, and the administrators take on, sort of liability,
Well,
339 liability.
They do have a fiduciary responsibility
Yeah, they
to
do.
act in the participant's best interest. They
And this is
absolutely
not.
do.
And this is not. I mean, this is
No.
egregious. Both the administration fees, the fund. You didn't even give us the fund expenses, but that's ridiculous. But here's my one solution. I would only save up to the match. I would put it in the riskiest asset class, so you hope to make more than what the charges are. In other words, if they had, any sort of small cap fund, if they had international small or any sort of value, I would put it in those risky assets. I would only save up to the 1.5% there, and then do Roth or some other option outside of that plan where you could get it for
Actually,
pennies, pennies, pennies.
if your wife is not funding a Roth currently and is only funding the 401k, stop funding the 401k
Yeah.
and just fund a Roth.
Well, I still like the 1.5%. Well, the 1.5%.
No.
Still, as you said, it's going up.
It's getting eaten up by the fees. So there's literally no benefit to the match.
Good point. Yeah.
There's no benefit. So just do a Roth. However, he continues.
Of course he does.
I suppose my wife's employer could eventually get tired of my helpful suggestions and fire her to get rid of me. But that wouldn't necessarily be so bad. That would mean I could roll the money to Fidelity and manage it much more affordably, and she'd have more time to play with the grandkids. And anyway, I'm 59. My wife is a few years younger. Our net worth is approaching the next plateau of $2 million. So we work because we enjoy the work and the companionship of our coworkers. Also, I'd prefer to allow her retirement accounts to double, maybe twice more, before we start to draw down.
Okay, that's a problem, because if you just said you're at 2 million and that's enough, then you shouldn't be working. She shouldn't have to work to double the retirement
right.
account.
Plus he said he wants them to double, maybe twice more. So
twice more?
Twice more.
Nah, come on. Especially at that fee base. That's
hopefully,
a couple more lifetimes.
Hopefully he's speaking. Yeah. Let's continue the last paragraph. We're nearing the finish line.
Exciting conclusion.
Thank you for at least considering whether this is a topic you'd like to share on your podcast. If you do decide to respond on the podcast or have your automated software read this email, please see if you can make my voice sound something like Richard Dreyfuss doing a Shakespeare play. Friends, Romans.
Oh yeah, that's right. From the where you had to play the slightly off kilter.
Or maybe not. You're right. Maybe not. We're going to go with maybe not. Or maybe you shouldn't read my name, given that I'm trying to help the school improve their offerings. We're not going to give your name. Not telling them.
We wouldn't do
I'm not snitching on you, Mr.
We are going to call them off the air, of course, to tell them.
We don't have the name of the school even.
Oh, that's too bad. I'd love to call the school and say, "Are you kidding
right.
me?" Okay, these are people that are not money oriented. They're not in the business of educating people to make a living. So let's make it more difficult for them to retire because we're going to charge outrageous fees, crummy mutual fund. No, let's go back. I think what you just said in the last 5 minutes is the crux of the matter. If you're in a crummy plan, and this is a crummy plan, what should you do? Don's right. If it's the match isn't even going to pay the fees, that is ridiculous. Simply quit contributing, set up a Roth IRA, which you probably already have, contribute fully to that. Is that $7,000, I think, now over the age of 50?
Yeah.
Put the money in there. You're not going to get two more doubles by the time you retire, even by the time you die. No offense, but
and dude, you live in Alabama. It's one of the lower cost of living states in the country. You'll be okay on $2 million, I bet.
Yeah, you can live and probably paid into Social Security, so you're both eligible for anyway. So yes, get rid of the plan. Maybe get rid of the job, because if she doesn't like doing it, then.
Well, apparently she likes the job. She hates the 401. And I'd like to just give a personal message to the people who own and run this small private educational organization. As the owners of a small private educational organization, my assumption is you are also educated, that you have an education. Usually they don't let uneducated people run educational institutions. Therefore, you should know better. You really should. You can see do you have any math in your past education? Do the math, and you'll see that you're shafting your employees which leads me to believe that either you or someone you know or care about is being enriched through this relationship. So who might the person be who is being enriched by this relationship? And doesn't it make you feel the least bit guilty?
By the way, when we started our retirement plan a few years ago, we only had 4 or 5 employees. We did it at a very low cost. So those things definitely exist.
I was just going to ask, when we started, now we have because we've merged with another company, we have a bigger 401k.
Yeah.
But when we were young, we had a very small 401k. I would imagine smaller than this private school in Atlanta. And we used a plan administrator and no load mutual funds and did it for
like a quarter of that cost, I think.
Yeah, wasn't it about 0.5% to the administrator?
Like 30 basis points.
30 basis points to the administrator and about 30 basis points for the funds, right?
Yeah. Mm-hmm. Yeah.
So around a little over 0.5% a year total.
Those plans exist. There's no question, even for small businesses.
Okay. I think we've done this one. This is a good one. That was actually a pretty good question.
I hope the guy's not mad. Thank you.
I'm going to give it 4. No. He can't possibly be mad because he harassed us mercilessly throughout the note.
That's a good point.
So if you can't take it, don't dish it.
Yeah, that's a good point, Tom. Too. And I'm well aware of that. Trust me.
I'm well aware of that. All right, kids. Thanks for joining us for our little podcast. Remember, if you have questions, you can send them in at talkingrealmoney.com, or you can call them in at 855-935-TALK. Also, we have this little, well, it's not little anymore. What is the whole, what is a Vestry and Appella manage now? 1.5?
No. It's over 2.
2.5? Yeah. Over $2 billion. So we manage a lot of money. And at Vestry, we have done something over the years that is unique. Everybody gives you what they call a free consultation. That just means come into the office. We're going to pitch you on becoming a client. With us, that's not what it means. It means we're going to give you a free meeting with one of our advisors to help you, even if you are a dyed-in-the-wool do-it-yourselfer. We're going to help you with some things that, hey, kind of elude help at times. Help you figure out what you have in your portfolio. Most people don't know. Help you get a plan started, which you probably don't have. For free. A meeting, not multiples. One. No sales pitch, no obligation whatsoever. Just go to vestory.com, vestory.com, and set up an appointment. Bing, you're done. Anything you'd like to add before I wrap this?
Bing, we're done. Thank you for the great update on the financial desk. I thought you did an amazing job on that. Maybe there's some opportunity there. I don't know.
I forgot. When I started doing it, I had totally forgotten that back in the day, I'm Don McDonald at the Financial Desk for Business Radio Network.
I remember it well.
I totally forgot that. I used to be the financial editor, and I did the news reports. I've always thought of myself as talk show guy. I forgot I did those.
You were the anchor man.
I was the anchor man. Yeah. Wow, that was a long time ago. All right, thank you all for being there, folks. We appreciate you. Come back tomorrow. We'll have another podcast if Tom's still with us.
I'm here.
We're hoping.
And I will return.
We're hoping he survives the meetings he has today.
Oh, God, let's not.
And you know what we're talking about, don't you?
Exactly. Please.
Thank God they're a long way away. They can't kill you in person. It'll have to be a remote death.
I'm sure that could be arranged too.
So if Tom joins, definitely tune in for tomorrow's podcast to see if Tom makes it.
The suspense is killing me.
Right.
As it were.
We've never ended the podcast on a cliffhanger.
That's a good point, by the way. Tune in just to see if
you have to, and you can't binge. You have to actually come back tomorrow.
That's a good point.
See ya. Take care. That's Tom Cock. I'm Don McDonald. We just hang out talking about money.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and That's a wrap.